Hello.
Hi, hello, good evening.
Good evening. While we're waiting, maybe you have questions on your models. Okay, lecture starts in 5 minutes. So now I'll switch off my video and we'll return in 5 minutes. Okay, it's time. Let's get started. Before we proceed with the model, I'd like to talk a bit about your models, about your assignments. First of all, please think about timing, because this week I have to answer about 10 emails from you per day. I expect that the next week will be a hot one. And as I said before, the last week before the submission, I cannot guarantee you that you will receive the answers from me quickly, because usually the last week is stuffed with all your works, and when 40 students at the same time send their models, that means that I cannot provide feedback at least in time, and sometimes I cannot give you any advice or feedback at all, especially in the last 2 or 3 days of the term. So if you do it, 1 second. If you do it this weekend, for example, you will definitely get some feedback and advice. But later, I don't guarantee that. And if you won't get any intermediate feedback, that means that you will have to submit your work sort of blindly, without knowing is it a good one or bad, and you will just have your mark. And I'd like to remind you that if you didn't submit your final version, the final version of your model by 6:30 on the next Friday, that means that you will sit for the exam. Okay, and I personally do not recommend you to go for exam, because yeah, okay, at the exam you will have an assignment for the model about the same as your homework, but I don't think you will learn anything from the fact that you made this model at the exam. And with your homework, you will actually learn a lot, because you can discuss it, you can do it step by step, you can fix your errors and so on. So please take it seriously and be as quick as possible with your intermediate versions of your model, and with any discussion that you need for the model. And as the first step today, I'd like to discuss not building a model, but correcting your models. I received many questions from you about your balance sheet that didn't balance for some reasons, and you asked me why, what happened in the model, why your assets in the balance sheet are not equal to the equity and liabilities. And I see that you see it as a big problem to find this type of errors. So I would like to show you how we look for any errors in the model. I'll start with something that I received today. I don't remember from whom, it doesn't matter. Okay, look at this model. So in this model, we have a problem. There's the balance sheet, and in this balance sheet, and this is how you should always check your models, take some period in the middle of the model, not the first one, not the last one, and check are total assets equal to total equity and liabilities. And we can see that here they're not equal. And by the way, to make this work easier, you should always check the balance in the model. Here, it's not done. So the first step for us here is to add this check. Check is equal to total assets minus equity and liability. Now you can see that something's wrong with your calculations. And it doesn't matter, is it a small difference or large difference? If the difference exists, that means that your formulas are not correct. And maybe you have much bigger differences in some other parts of your report. You just don't see them because you can check it easily only in your balance sheet. Okay, so we can see from this fact that something wrong with our model. But we have a large, complex model. And how do we find where is the source of this problem? We do it this way. We will now start deleting the model step by step, simplifying that. Of course, you should never save your model in the middle of this process, or you should save a copy of this model just to be safe in terms of saving, accidental saving of the model. Okay, now what we do? We put our balance sheet to this position. Now I return to the model, to the assumptions. Construction stage. Okay. Let's select the whole construction stage and just press down. What happened here? Some numbers have changed. That means that probably there are some errors in the construction phase, but maybe the reason is different. Maybe the construction stage is good, but some numbers from the construction stage processed incorrectly later, like maybe we have incorrect calculations of taxes or things like that, but we don't have zeros here. So the error is still there. Return to the model. Well, now, operational stage. This part is 0. Let's go further. Expenses, marketing. I will do it in one step. All expenses. Remove it. Check the balance. The error is still here. Okay. Personnel. No, it's not about personnel. Sales. It's not about sales. Taxes. It's not about taxes. We have just financials, finance actually, not financials. That's not an answer because with finance we just removed everything. So the last step was finance. Maybe something wrong with our calculations of finance. Okay, let's remove, as the first step, let's remove our interest expense. No, it's not about interest expense. Let's remove the equity. It's not about equity, but now the model is very simple. We have just several numbers here, and now we can check what's the difference. You can see that the difference is equal to this first number. Or maybe we can simplify it even more with this loan and repayment of loan. What if I remove the repayment? No. What if I remove this payment? Still no. So something wrong with this number. And now I can look at the balance sheet, and here I can see something strange. I received a loan. Here is my loan. It's I get this cash. So in the first period I have cash, but in the next period this cash has disappeared. Why it's disappeared? Now we can check the formula here. It's cash flow statement C35, cash flow statement C35. It's total cash for the period, but we would like to have in our balance sheet cash at the end of period, not for the period. So we found the error. The correct version would be cash at the end period. Which is equal to this plus cash for the period. And with this correct link, the link to this line, our balance sheet will be okay. So we can now close this file without saving, go back to our original version and fix the error there. So this is the main approach to find an error in your financial model. Just go back to your assumptions, to your calculations, select them module by module and remove those parts of the model, waiting for the moment when your error will disappear from your final calculations. Well, okay. Now let's go to my model, and today we're going to discuss the last stage in this calculation, which is, one second, what if analysis. What if analysis, or scenario analysis, or sensitivity analysis, and so on. Last week, we actually pretty much got a final working model, and we can use now this model for any type of analysis we need. We can change, I don't know, any parameters, and we get complete financial reports and analysis for this project. But with this model, we still have a couple of problems, a couple of things to do. The first one is that when you present a project and present your model, you can this model is based on forecasted values, and that means that you cannot prove that the values, the parameters you put into in your model are actually something that will happen in real life. And let's take it. Let's say that we actually even don't want to present something as just one scenario, one forecast, because we don't want to be responsible for this one forecast. We cannot be sure that that this is exactly what will happen with our project. So when we discuss this project with investors, with management of our company, with anybody, we want to show that yes, this is our forecast, but things can change. Something can go differently with this project. This is important both to avoid this excessive responsibility for our model, and to build good relationship. Well, I would say that good relationship with those who make decisions on this investment, because we cannot prove that this is exactly what will happen with this project. And because of this, we will need, actually, that's why we build this model with formulas. That's why we make it dynamic, make it changeable. We would like to show with this model all possible range of outcomes for the project. And depending on the style of our communication with the investors, on the style of our negotiations, we will use 3 different approaches to this what-if analysis, to these scenarios. So the first one, and I actually saw that some of you made this part in your models. So the first one, we will call it sensitivity tables. Let's add another sheet to our model. And we'll call it what if. We will put all our scenarios and sensitivity analysis on this sheet. So the first part would be sensitivity analysis. I'll tell you something about sensitivity analysis. What is sensitivity analysis? We will build a chart or a table that will show how changes in 1 or 2 parameters of the project would change some outcome of the project. And we usually present this information as as a deeper analysis, as something that will show our investor all possible spectrum of the outcomes and so on and so on and so on. People always put it this way, but in fact, I work in investment analysis for 25 years now, and I never saw a case where investor or any decision maker actually used sensitivity analysis of any kind. I mean, even sensitivity analysis, not scenario that we will use later, but sensitivity analysis. Used it for real decision-making process. So this is just like an illustration. This is a I know a part of beautification of our model. And another reason why we add sensitivity analysis is we usually try to show that this project is pretty stable, even with small deviations in our parameters. It's still profitable, and so on and so on. So what's important in this is that the sensitivity analysis is not a very powerful analytical tool. This is a very powerful presentation tool. And because of that, you will heavily use sensitivity analysis in your financial model if your financial model is something that used for final presentation of a project. And that means that you don't expect that you will sit with your investor and your model and change something in your parameters and discuss possible range for the parameters, for possible range for the outcome of the project, for NPV, for any other indicator of this project. So when your model is more a presentation tool, you will always add sensitivity analysis in your model, maybe several tables with sensitivity analysis. But if your project or your model is more a tool for negotiations, for discussion, then you can remove these sensitivity tables completely, or you will not use them as a powerful analytical tool. Okay, but how we do sensitivity analysis? 15 or 20 years ago, we would add in our project sensitivity charts. And sensitivity charts are charts where you show how change in one parameter, some parameter usually, things like sales volume or sales price, things like that, how they change some outcome of the project. Nowadays, we usually build sensitivity tables, and the only difference is that we show how changes in two different parameters influence the outcome of the project. Let's look at our project. What parameters we have? We have like capacity and its utilization. We have price of cement. We have many different raw materials. We have many items in general expenses, and so on and so on, right? To build a sensitivity table, we will need two numbers that we believe are key for the project efficiency. What would you use as those two numbers? choose something. You can type it if you don't want to say.
Maybe what rate?
WACC,
What? Value added tax.
VAT. Actually, I don't think so, because yeah, it can be a parameter. That's that's an interesting approach. The problem with that is discount rate. Okay, is one. Yeah, okay, this is one possible. Why not VAT? Because with sensitivity analysis, we would change this number in some range. So, for example, today it's 20%, and we would say what if VAT is somewhere between 15 and 22%. Let's recalculate the project for all those values. But the problem is that this range or this change in VAT is something, is it something plausible? Is it something that can happen in real life with our project? Of course, if we look at it in long-term forecast, the VAT rate can change, but with our project, we have so many other things that can change, that can in real life be different from what we put in the model. So VAT rate isn't a good example for the analysis. Actually, if we set a question like this, that can harm our financial model, because the investor or decision maker will not use the analysis like this, because they don't believe that these numbers can really change. So they will start their own analysis. And the main idea with any sensitivity or what if analysis in our financial model is that we would like to ask all questions about our project before the investor asks these questions. Because if the investor asks these questions first, that means that we don't know the answer. And maybe the answer would be not very beneficial for us. So the idea of sensitivity analysis is to ask all questions first, and only then go to investors with some questions prepared for them and answers prepared for those questions. In this case, we will control the discussion. We will control the negotiation. So the idea of what if analysis is that we come with our base case forecast and answers to all possible questions. Okay, so no, not VAT. And two other offered parameters, discount rate and WACC. They're better, but WACC is and growth rate. WACC is something that can be calculated from the discount rate. So the growth rate, yes, it's good. The discount rate for equity is another good example, because we don't know what discount rate should be used for this analysis. That was something that we put here just based on our expectations. What if the investor has another requirements and other expectations for this project? So yes, cost of equity is the first example. Second, inflation rate. That can be another example. We have in the model, we have many inflation rates, but we used the formula here. So probably the correct style for that would be this. Only this is our input number. These numbers are calculated. So inflation rate, good example. Equity, cost of equity is another good example. Not scenarios, Konstantin, not scenarios. We're doing sensitivity analysis now. So we cannot build a scenario with many parameters changed in one point of this scenario. No, we need just two numbers for the sensitivity table. But you're very close to what we have to do. What actually is the most unpredictable part of any business? It's sales. And our sales revenue, yes, our revenue is based just on two numbers. Yeah, we have more numbers. We have capacity utilization here, and capacity utilization is many numbers. So we exclude it from our short list because we need just one number or two numbers. So we cannot use capacity utilization for the sensitivity table. Should we use capacity? Generally speaking, we can, but capacity is more a technical number. This is something that defined by the equipment we use. So the best candidate here is price, right? The best candidate is price. So actually, for all, maybe not all, but 99% cases, sales price would be the first candidate for your sensitivity table. Something like discount rates. Yes, discount rates can be another parameter, but I would like for the first sensitivity table, later we can add another sensitivity table, but for the first sensitivity table, I would like to use some parameters that change the budget, that change the financial reports. And discount rates, they don't change financial reports, they change how we treat those numbers. So another number I would use, you were very close to this number when you thought about discount rates, but we have another rate here, interest rate. Interest rate, from one side, it's like a part of our discount rate, a part of our WACC, but from the other standpoint, it's a number that changes our financial reports, that changes actual cash flows available for the shareholder, right? So the second, for my first sensitivity table, the second parameter, by the way, here, the principle is the same, it's calculated. So we have just one number for this loan, one number for price, one number for the loan. Now let's do some technical work. How we build a sensitivity table. First, we will decide that in columns, our numbers will be the numbers for, let's say, for our sales price. The base case is 4,100. Let's put it somewhere in the middle of our model. And then we'll do something like this. So this is the range of prices that we will analyze for the sales price. Now, in rows, we'll put various interest rates. It was 10% for our base case. Let's say that we start with 8%, then 8.5, and so on. We go to 10 and then to higher values. Now we have a table. The next step, in the top left corner of this table, we should put a link to the result of this project that we will use as the outcome for our analysis. And the most natural result that usually used in sensitivity tables like this is our net present value for the project, because it's just one number. Again, just like with our two parameters, the final result cannot be things like net income, for example, net profit, because net profit is something that we have as a range, as a set of numbers for each period. We need something that presented as just one number. So here we put a link to our net present value, and we will use, let's take something. Well, let's actually take this one without terminal value, but we will have to change our discount rate to something to make sensible numbers. So let's say that our base case discount rate, cost of equity, is 20%. So now we have efficient project as the base case. Let's forget about terminal value for some time, and we will analyze. Oh, sorry. Where should I put? Ah, no. Actually, we can use some higher discount rate. Okay. Now, the next step, to fill this model with values of net present value for each combination of this sales price and this loans interest rates, we should make this net present value dependent on these numbers. So we should link our calculations to current values from this. And the problem with a technical issue with this Excel tool is that we cannot build those links, we cannot use those formulas from one worksheet to another worksheet. So the first thing, we should create two cells here on this sheet for those numbers. So sales price and loan interest rate. And we remember that the sales price for the base case is this one. For the loan, it's this number. Now we mark these two cells as our input data. Now, from this moment, we will edit those numbers on what if sheet. And we go now to our project sheet, and here we link it to what if. This is not an input data now. Maybe we can mark it somehow specially so that you can see that this number has a special formula. It has a link. Let's choose some other color. It's not just calculated as all other cells on this sheet. This is a link to what if analysis. And we do the same with our sales price. Okay. Now we can change the numbers here, and you will see that the net present value will change with those numbers because we control now our project from these two cells. And now the last step. We select the whole table we prepared. We go to data, what if analysis, data table, and answer to simple questions. Row input cell. So this is our rows. Row input cell is 10%. Column input cell is our sales price. Oh, sorry. I'm afraid I used incorrect numbers here. 1 second. And by the way, it's the opposite. 1 second, we have to remove circular dependencies here, because without that, we cannot restore our model after any error. So now, I always mix those numbers. So row input cell means this one for this row, and the column input cell is this one. Okay. Now we calculated all range of possible outcomes for our net present value. Let's format it. It's numbers just like anywhere. And we have this this table. If the table you want to, if the sensitivity analysis you want to use would be a sensitivity chart, we would take something like this and build a chart for these numbers. And that would be our sensitivity chart for various values of our sales. And you will see with this chart the dependence of net present value from our sales price and so on. Last year, maybe recent years, this style isn't that popular. So people usually use the table. And in the table, the problem with the table that you cannot see the dynamics. It's just like a bunch of numbers. So it doesn't look very informative. To make it more informative, we select all those numbers and add conditional formatting to them. We will highlight all cells that are positive as green, and we will highlight, we will highlight all negative values as red. And now it looks like a picture that shows us the range in which this project can actually work, that can be profitable. You can mark your base case on this chart again to make it more informative. And here is how we build this sensitivity table. And with the sensitivity table, we just showed how this project react on any changes in sales price and so on. And you can see that with base case, we can tolerate about maybe 100 rubles change in price if the interest rate will be lower. Then we can tolerate about 200 rubles. With this price, we can pay for the loan if this loan will be up to 12.5% with the interest rate and so on. And we can add another sensitivity table with two other parameters. We can actually add many tables to this model. What are the problems with this approach? Why we're not completely happy with this idea and with this analytical tool? There are two problems. One, this is not actually a problem, but this is a technical thing that you should take into account when you add sensitivity tables to your model, to your project. Look, let's select this model and check how many cells are there. It's 88 cells. What does it mean? That means that if I go to the project sheet now, and if I change anything in this project, like change for example, from 50% to 40% here, then the model will be recalculated not once, but 88 times. On my computer with this model, you cannot see any change in style, how Excel works. But for a bigger model or on a slower computer, you will start getting troubles with your model, because if the model is a very complex one, or if you have several various what if tables, we can actually play with that. I'm not sure that I can copy the table. No, it doesn't work this way. We would have to create the model. Now it's just a copy of that one. But if you have several sensitivity tables, or complex model, or slower computer, that you will come to a moment when any change in any cell in your model will take 2 or 3 or 5 seconds for Excel just to recalculate. And when you type enter, you have to wait several seconds until you can go on. So it's impossible to work with a model like that, right? So the first problem with sensitivity tables is technical. There is a way to solve this problem. We can go to options, to formulas, and change calculation options from automatic to automatic except for data tables. If you choose automatic except for data tables, that means that if you change anything in your model, that all calculations will be done except this one. And this calculation will be done only if you press F9 to recalculate the whole model, or if you choose recalculation in your toolbar. Okay, so for the first issue, there is a way to solve this problem. But there is another problem. We presented it as some analysis, some what if analysis for our project. But wait, let's take this this cell, for example. In this cell, with price 3.9 and 8% for the loan. Yes, our net present value looks like a positive one, so the project is okay. We can go with this project, and we're not afraid of these prices and so on. But is net present value the only thing that changed in this project? No, actually, many things change. For example, if we change the price, then the schedule for our loan will be changed. Don't forget that we automatically calculate the loan. So our loan will be automatically rescheduled for the new parameters. But if we discuss our project with the bank, then the bank will probably expect that this loan will be fixed. It will not change, right? And the question from the bank would be not if your net present value is still positive, but the question would be, can you still repay the loan according to the schedule from the model, right? And the schedule for the loan is not one number. This is a set of numbers, this repayment, right? So we cannot apply our sensitivity analysis to demonstrate the bank that we can afford this loan. This is the first problem. Another thing is that we actually spend quite time just to answer to the question what 2 parameters we will use. and we decided not to use many parameters of this project, parameters that can be very important for the project, but their structure, their format just wasn't convenient for us. For example, I will go back to our sales, and I'll ask you, what another parameter in addition to sales price, what another parameter in many projects, in many businesses is unknown? What can be a parameter that create risks, real life risks for this project?
Maybe
I think not costs, no. The second parameter is sales volume. So two basic questions for any project. Can you actually sell this product with this volume and this price, right? And in most businesses, actually, not the price is something that can change in real life, but the volume. So the question for the analysis would be maybe not the question about price, but the question about, can we actually, when we start in 2025, get 50% utilization in the first year of the project? Can we actually sell 80% of our capacity in the second year of operations? And is it plausible that we will have 100% utilization in all further years, right? But we cannot use our beautiful sensitivity tables for this analysis because we have like 7 numbers here, right? So we cannot apply this approach to our capacity utilization. And maybe we have other numbers, other things to change. So the problem with sensitivity analysis is that we have just 1 or 2 parameters. If it's a chart, it's 1 parameter. If it's the table like this, it's 2 parameters. But 2 parameters are not enough for us anyway, right? And this is another reason why sensitivity tables are usually just a way to present some risk analysis in a beautiful way with this colorful table, but this is not a powerful analytical tool. Okay, let's build a powerful one. Scenarios. Okay, what's scenario analysis? With scenario analysis, here we had 88 different combinations, different cases for our project, and we calculated them very quickly without any deep analysis, but we had many of them. With scenario analysis, we will create just 2, 3, 4, maybe 5 scenarios. Usually it's 3 scenarios or something about this. And for any scenario, the difference will be that we will be able to change any set of parameters for those scenarios and analyze anything for each scenario. Now, how we build those scenarios? Let's start again with some technical things. So what parameters will go to our scenario analysis? Let's start with what we just discussed, capacity and utilization. I will copy and paste it to my scenario analysis. And in the main project, I will now change how I collect this data. It's not the input data now. Wait, I will do it later. I will go back to that later. What's more for our scenarios? Let's say that for this project, we can actually build different cement plants, so we can have different capacity, not just capacity utilization, but for those different plants, capex will be different as well. So our capex here, let's take this part, the whole part. Maybe the building will be the same for all scenarios, but this part will be different. Okay. So for all scenarios, these numbers can change. And that will be our base case. Base case. And now let's say that we have three different scenarios. First is just a pessimistic case. In this case, all capacity and investments would be the same, but our utilization will be lower. We'll start with something like 35% here, 70% here, and we get just 90% capacity utilization. And another case, let's copy from base. Another case would be something like a bigger plant. And let's say that, just to make it simpler, let's say that this bigger plant require more expensive equipment, but all our staff costs, all our operating expenses are the same. And with this bigger plant, we will pay for this piece of equipment something like numbers, but its capacity will be 100,000 to 200,000 tons more, and utilization will be the same as our base case. Of course, we could change any number here. Okay, now we have three scenarios. After we prepared all input data for those scenarios, we should create the current scenario. For now, it will depend on this number here, and this scenario, it's actually a copy of these numbers. But instead of using input data, we will present them as just calculated numbers. Actually, one second. And we will use select, oh, sorry, choose function, choose based on this index. If it's 1, we choose this number. If it's 2, this number. If it's 3, it's this. And we can now apply the same formula to all numbers here. Okay. Now, when I change the number here, my scenario changes from base case to the second to the third. To make it more clear, I will use the same formula. Second here, and we will show the name of the scenario. So my current scenario is bigger planned, for example, then I can use base case or pessimistic case and so on. Now, I have the switcher for those scenarios. So I have 3 scenarios, 3 set of input data, but this data isn't linked to my main model. Now I go back to the project and link all the model, all the data in this model to my scenarios. So this is data from scenarios, and the same we should do with our capacity utilization, capacity and capacity utilization. So this is the link to this. This is the link to our utilization rate. For now, nothing changes in the model. Because we have base case scenario. Oh, sorry, it's percentage. We still have the same net present value as we had before, but you can see now, you can quickly see our net present value here. So if I change my scenario to a pessimistic case, here how it looks like. If it's a bigger plant, it's very beneficial to build a bigger plant with parameters like this. So we can switch between those scenarios and quickly see all the information. For example, for a bigger plant, I can go now to financial results, to the reports, and in the cash flow, I will see all information about my new investments, my new loan used to finance this plant. Now I need 8 billion rubles, but in the first scenario, in the base case scenario, I used just 6 billion rubles. So even if calculations with the third scenario look better, this is actually a big question. Can you implement the project with third scenario, because it requires 2 billion more in debt, and the question is, can you afford this debt? Okay, so with this approach, we build a model with which we can switch between several scenarios and see all the information. So now we can change as many parameters as we want in each scenario, and we can collect all reports, all indicators, any financial analysis we need for each point. What we loosen with this scenario, we'll loosen this 88 points. We have just 3 points. We'll loosen this beautiful chart. And by the way, you should be careful with the combination of sensitivity analysis and scenarios, because, for example, with a scenario like this, with pessimistic case, you have like risk analysis over risk analysis. So you have 2 levels of risks applied to your project, and this is actually quite hard to digest this information. So we usually build or present and use sensitivity analysis for the base case only. So, and you actually choose, will you use the sensitivity table or scenarios? You can have them both in your financial model, but don't use they at the same time. Choose one or another. Okay, and by the way, if you used scenarios in your model, then you will probably simplify using of this model for yourself and for all decision makers who use your model. If you do things like that, we will add in the title of all our reports a link to the name of current scenario. Can be something like this. And with this style, you will always see what scenario is in the calculations now. and the same for DCF. So, okay, now we have the second tool. The second tool for this dynamic analysis during negotiations or presentations, but still this tool is actually more for things like if we prepare a business plan or presentation of a project, and we need those scenarios just to present this project from several possible points of view with several possible forecasts. And we usually, by the way, how we choose our scenarios. We usually choose the most popular approach is to build 3 scenarios. First is your base case. This is what you believe is the most probable outcome of the project. The second case would be some optimistic case to show that this project can be actually better than what you forecasted for it. And the third case, the case that will be pessimistic in some way, we build at the level that gives us net present value close to 0. So that just like with this sensitivity table, here investors look for this line between red and green, and your pessimistic scenario will show the investor another presentation of this line. It will show a pessimistic scenario that puts the project at the break-even level. But don't make those pessimistic cases too bad, because of course most projects can be lost completely. So we can create a very pessimistic case with too much pessimism. But a good approach is to build those pessimistic cases at the level of break-even, at the level of NPV equal to 0. Okay, and again, this is an example of analytical approach, what if approach prepared for a presentation, not for negotiations, right? What if I expect that I will use this financial model for negotiations? So we will sit with the investor, we will sit with decision makers, and we will discuss the case, discuss the project. In this case, I will probably do something the following. Let's create another sheet. Summary. We built some summary for most projects, for most models. So a summary sheet will be in some form for any in any project, but here we will use it for a different course. Key parameters. So the idea is that I don't remember, probably I mentioned that some financial modeling standards or recommendations recommend to put all assumptions on a separate sheet, so to separate assumptions from calculations. I personally don't like this approach, because any project has a a lot of assumptions, and it doesn't mean that we will work with them all. So we don't need all those assumptions on a separate sheet that creates just the same mess as many other bet styles. But if you expect that something will be discussed with your investor and some information is very important for the investor to make decisions, then you should collect those assumptions together with key parameters on a separate sheet. Here, we'll use it this way. Key parameters, key results. And key results for us will be like NPV for the investor, maybe with IRR, let's say that, for example, the loan is very important for us. So you can create this set of most important information, and key parameters here can be, we created 3 scenarios. So let's still use it. So the scenarios. And for this scenario, we now change the control. Now this number will be equal to the summary number. So we can manage our scenarios from the summary. And so on. And here we can change any number we need, actually. Like DSCR, for example. I don't know, or let's say that DSCR will be fixed, but for example, owner's contribution will be managed from here. And in project, it's linked to this summary. And something else. Maybe we mentioned that VAT rate can be a parameter. Okay, why not? Why not? So we collect here the important information for the negotiations, so that after 1 second, you will need a link to the summary. So during negotiations, we can sit with the investor, with decision maker, and change just a small set of numbers on this sheet without going through the whole model. What if, for example, investor has just 1.5 million rubles. Well, it looks good for him. What if VAT rate is 22% instead of 20? That's about the same. Why it's about the same? Because our prices are without VAT, so VAT added on the top of our prices, and it changes just very small things in our working capital, actually. So it doesn't matter what VAT is for this project. But if all our prices were with VAT, those changes would change our cash flows, the cash flows for the investor. So in this case, with this style, VAT rate doesn't change a lot. What if investor can invest more? Oh, sorry. Can invest more, but in the third case with bigger plant. Yes, okay. And with the bigger plan, the necessary loan would be not 8, but about 7 billions. With this higher owner's contribution, 7 billions probably is something possible for the investor, and so on. So this is the third and the last way to add these scenarios and what if analysis in the model. And with that, we finished our part for today. And as usual, if you have questions about this part or about your models, we can discuss now them live, or you can ask your questions in your mail.
Good evening. I have a question about this part, about sensitivity analysis. I just cannot understand why we use interest rate. Not why we use, but what we mean when we use interest rate. We mean that we can issue debt under different interest rates, and we since did not issue debt, or what?
Mm-hmm. Yeah, imagine. I understand the question. So why interest rate can be different? Why we believe that interest rate is a risk factor for this project? Imagine that you developed this model in June of this year, going to raise debt to finance this project. But while you working on this model, you don't have a contract with the bank. So your interest rate isn't just fixed. You didn't even discuss it with the bank, because before you start discussing your interest rate, you will have to build the model. So you build in the model with expected interest rate, but there are two factors. First, you didn't get an offer from the bank, so you don't know what will be the interest rate in the bank offer. And second, it will take time to discuss your project. And in June, you made the model, and in December, you eventually signed the contract. What do you think will be the difference between expected interest rate in June and in December this year? I think that the difference will be about 2%, right? That's why the interest rate is our risk factor, just because it takes time to get from the model to financial closure of the project, and the actual interest rate can be different.
Okay, thank you. And I have one more question about my model. I asked you it's in mail about research and development costs. Are there any situations when we don't count research and development costs in our DCF models, but we know that we must pay for it?
No, I don't think so. But look, the first thing in you asked a couple of questions, right, about different costs. You shouldn't actually think too much about how you present those costs in your accounting. The main question is, will you pay for it? If you pay, you put it in your model, right? Because your model, first of all, your model is about cash flows. So if it's in your cash flow, it's in your model. But there are two exceptions. First, in many cases, you have your R&D costs not after you make decision about the project, but before that. So you start with R&D, and when you come to some result with your R&D, and you have now reasons to invest a significant amount of money, at that point, you make the model and you calculate everything. So your R&D in this case is not just in some accounting principle, but what's important, it's behind. You already spent it, right? And another principle is that I will start with some theoretical idea. Theoretically, if we spend anything before the decision about the investments, then we call that sunk costs. So the costs we cannot change, right? And we do not include it in our model. The theory tells us this, but the practice sometimes is different, because in many cases, the investor, the management, somebody who uses your model, they need this model not just to make a decision about the project, but also to see the whole picture of this project, to see the complete result of this project, even if this is not a basis for their decisions. So many investment projects calculated in these financial models, not from the moment of the decision, but from the beginning of the project. And that means that, for example, in January this year, you started R&D on this project, you invested some first money in some preparations, and now you go into the bank. So you need the main part of your investments, and that's why you build the model. But you build this model, although it's December now, you build this model from January, and include in your model all things that already happened with the project. That's because our models are not used only for the decision making. They used for some reporting about the general result of the project. So if you build the model from the past, not from today, then you can include even the money spent in this project. That's not very correct approach for decision making, for calculation of net present value, but for report reasons. That's okay, and that's what people often do. So this is the first thing, right? And another thing is the relevance of your costs. Sometimes your R&D or any other cost started because of this project are actually used not just for this project. In this case, you can also exclude some part of your cost just because you believe that they're not relevant for this project. So the project was the reason why you decided to spend those money, but not all those expenses are linked hardly to your project. So some general R&D can be just partly used in your financial model. So, but with those two exceptions, all other cash flows should be presented in the model, and it doesn't matter what they are. Are they capex, opex, or anything? That's about your costs.
Thank you.
Okay. If nobody wants to discuss the model here, I'm waiting for them on email. As I said in the beginning, just in case you missed it, next maybe 2-3 days, I will definitely answer all the questions, and I will have time to discuss your models. Last 3-4 days of the term, last 3-4 days before the due date, and due date is next Friday. I cannot guarantee you feedback because usually by that time I receive the models from you all, and this is just too big a stream of models to discuss them all. So be quick with your submissions. Otherwise, just submit your final case by the next Friday. Okay, see you. Bye.
Wait a minute.
Yes.
I have a question. Yeah, in the end. So, am I right that we will send you our models till the Friday, and then on the next week we'll have exam, and by the date of our exam, we will know whether do we need to sit for this exam?
No.
Or how?
No. The principle is different. If you submitted the model by the next Friday, you don't need to sit for the exam. You get your mark from your model. And actually, if you submitted that for discussion before, then before the submission, you will know that your model is good or bad because you will have feedback from myself. If you just submitted the model blindly without any discussion, then before the exam, you will know your mark for the model. And if you want, you can say me that, okay, I want to sit for the exam to change the mark if you're not unhappy with your mark. So,
Okay.
mhm. So basically, you don't need to sit for the exam if you submitted the model. But if you see that the mark for the model is bad for you, and you want to change it, that you will have the second chance. You can sit for the exam.
Okay, I get it. Thanks.
And will be the final mark the maximum of 2 or a mark for exam?
It will be maximum of 2.
Thank you.
So if you have good or decent mark for your homework, and you decided to try with exam but it got a worse mark, I will not use your mark from the exam.
And did I correctly understand that the exam will be like to build a DCF model based on reports or not?
No, not based on the reports. You will get some parameters of a project, and you will have 2 hours to build the model quickly. It will not be a model like in your homework. Of course, it can be simpler, but it still must be a financial model with assumptions, calculated financial reports, and efficiency for this project.
Thank you. And will these parameters be like something for possible revenues, or we should think about imagine possible revenues and possible costs?
There will be all parameters like we start in a business. The capex for this business is like this. Sales will be the following: this volume, this sales price. We will have these operation costs. So please build financial reports for this model, calculate project efficiency, and make decision about this project.
Thank you.
Anna, if nobody have questions about financial models, we'll come to your thesis later. So any question about models?
Sorry, Professor, I wanted to ask you about my model.
Yes,
You
yes.
answered me today, and I wanted to know your like general opinion of the model. Can you
Wait a second? Yes. Yes. You had hotel, but changed it for juice
yes
production. Yes. 1 second.
and I answered to your email today about the debt and about the loan situation, and
Yes. Yes. You try to use a formula that works without circular dependencies, right? Without circular calculations.
yes, there's no circular.
Yes. That's good to have a model without iterative calculations, but that's not good if this model does not calculate what you need to calculate, right?
Yeah, but I didn't understand from your email, like
I'll show you the model. 1 second.
because you can like my logic was that you can choose whatever the loan you want, and whatever the percentage you want, and based on that, equity financing is calculated, and if the business will not have some cash, it will
Look.
show you how much money you need to give in
Yes,
addition.
I understand. I understand. The problem is that with your project, look, let's go to financial statements. By the way, I don't recommend you using a style like this. Look, you have a title for your reports, and this title actually takes about half of my screen, right?
Yeah.
So it's hard to work with a model like this. Okay.
Yeah, actually, my computer is like 23 inches, so I didn't think.
Yeah.
So it was okay for me, but I didn't think.
I have not a very small computer. It's like 15 inches, which is pretty standard for notebooks, and you can expect that maybe 90% of any user of your models will use notebooks. So
yeah, currently I'm at 30 inch, and I see that it's quite small.
Yes. Okay. So I'll go to your cash flow statement. Look, this is our debt financing, and in this debt financing, I can check something like this cash flow from. We can see better if we change equity part.
Loan part, like
Yes.
it's loan part.
Yes. Let's make it bigger so that everything will be easier to understand. Look, your idea is that this project is okay if we have positive cash at the end of period, right? So it's enough, and this project will be financed by a bank just because in your financial model you can show that you have enough cash to repay in this period, for example, to repay the loan, right? This is your idea, and you believe that you proved something to the bank. But let's look at this in the way the bank looks at this project. This is what you pay to the bank, right? And in total, that gives us $14 million, right? Total cash earned in this period by your project is about this number, right? And that means that in this period, DSCR for this project is one second. DSCR for this project is what's going on? Why it doesn't show me anything? Looks very strange.
Yeah, maybe you can apply the format from another cell which has separators. Like probably I will I have it above.
Yes, but okay. Anyway, we can see that this is actually can I? Oh, and now it's updated. Okay, it's 1.2, right? For projects like that, a bank would agree to finance your project with DCR at the level about 1.5. So this is not an acceptable project for the bank. And actually, we got this 1.2 only because your sales are growing very quickly. If your sales would be more flat, we would get 1 here, and 1 is absolutely unacceptable for any bank, for any project, for any standalone project.
So I see that the point is to make that DC the debt service coverage ratio is not less than, let's say,
At 1.5, for example, yes. And this parameter, this 1.5 or 1.4 or any other number, this parameter is as important for the bank as the interest rate or sales or other parameters.
okay.
So you just you created this simpler formula by avoiding an important part of the analysis and the important part of budgeting and calculations. Your model doesn't have circular dependencies, but your model just doesn't do the job. Understand?
Yeah, thank you.
That's why, yes, we're not happy, but we switch iterative calculations on, and we add calculations based on DSCR, just because otherwise we would have nothing good for the bank to analyze and to discuss.
Okay, thank you.
Okay. If no other questions about the models, I saw a question about thesis. What do you want to ask about thesis, Anna? Sber as the company. Yes, you can. You can. Basically, yeah. You just can use Sber as your subject company. So if you choose Sber, then fill the form with your topic and with Sber as the subject company in the topic. Send it to me and I will sign it. But I'm afraid that I will sign it tomorrow. No, it's not. It's a problem for you. It's not a problem for the task. Yes, Sber has many businesses. Yes, it makes it harder for you to analyze it. But the topic is correct. Okay, and please send the form, but I will sign it tomorrow because actually it's night here where I am now. It's too late. Tomorrow I'll be in Moscow and I will send the form. Okay, so see you next Friday. Bye.